Hello viewers, if you really want to make some positive returns in your investment portfolio with low risk opportunities, watch this video. I'm going to review for you Dropbox's most recent results. Stick around to the end, you'll see my thoughts on the valuation as well. But as usual, this isn't financial investment advice, so do your own research. Let's dive right into it. So part one, we're going to have a look at the results. We're looking now, because they completed their fiscal year, the results were released for the fourth quarter. We're now into basically their full year 2021 results. We've got a really clear picture of what's going on. And the key highlights, kind of executive summary for you, is this total revenue increase at 12.7% year over year. So it's a decent level of growth, not super fast, but not particularly slow either. And the really interesting news here is around the users. The average revenue per user has increased. Now, if we just bring up sort of the quarter four numbers, just to get a bit more info on that. The number of paying users is around about 17 million, and it was 15.5 million at the same period last year. So there's actually been a very nice increase in the number of paying users. If we have a look at this very stylish diagram that I've drawn, the actual number of registered users is 700 million. Now let's just say, for argument's sake, half those are sort of old legacy accounts that aren't really used. You might say there's 350 million users as a bit of a guess that are active to some degree. Now, if they've monetized, let's say, around about 17 million of them, that is only 5% of the potentially partly active users that are monetized. So all this blue section here has potential to be monetized to some degree. So I think there's a lot of upside looking forward in terms of the users that could be monetized. So heading back to the overview, I'm going to look at the results in terms of the net income. The income was over $300 million. It was a loss last year, and they had some impairment charges there. The actual income result looks pretty decent. But I'm most interested in the cash, because the profit and loss and net income, that could be subject to all sorts of sort of accountancy tricks, what have you. But for me, the intrinsic value of the business is based on the amount of cash it generates for its shareholders. And that is essentially your operating cash flow minus your capital expenditure. And that's how much cash is generated for the shareholders. So the situation here is the net cash from operating activity is 730 million. And that actually translated into free cash flow of 708. Really low capex, very, very high free cash flow generation there. So if you just remember that 700 million number, which is a lot higher than last year, because we'll need to use that number later on when I go through the valuation. So finally, on the executive side, we've got an 85 cents earnings per share. But on the non-GAAP method, it's 154. So it's quite tricky to actually work out what the right number is, which is why I focus a bit more on the cash flow. Now, very interestingly, there is a share repurchase program that's been authorized, and that is for 1.2 billion. Now, the stock is trading at near 52-week lows, so that feels like a very sensible use of cash given the current pricing position. Again, remember this number, because later on we're going to see some jiggery pokery around dilution as well, so it kind of offsets this. Right, looking at the profit and loss summary, and I'm looking at this sort of 12-month period. I don't really look at the quarter to quarter as much. The greater trend you'll see over the 12-month period. So we've got a revenue increase there, so that's a tick in the box. Very big R&D numbers, so there is potential efficiencies there in the future. It is taking a lot of money for them to actually develop their products and stay ahead of competition. Operating expenses are down, and that's because of the impairments in the main. And we've got here this 300 million profit before tax. Working this through, you get to 336 million income, and then 0.85 diluted earnings per share. And compared to the previous year, the number of shares outstanding is quite different. Again, a positive there that's delivering some additional value to the shareholders. So of the financial statements, we'll now look at the second, which is the balance sheet. Now, there's a much higher number of cash and cash equivalents. And overall, the current assets are much larger, therefore. Now, do note the goodwill's gone up there by around about 50%. So that'll be interesting to see why that is. But overall, the total assets are significantly higher than the previous year. But looking at the liability side of things, everything looks okay apart from suddenly this very, very large figure of almost 1.4 billion in convertible senior notes. And what that means is the total liabilities have gone up, and therefore they've got a negative equity in the business, actually negative $300 billion or so. And we'll come back to the senior notes in a second. So again, remember this 1.4 billion figure. So finally, looking at the cash flow statement. So we've seen the 730 million from operating activities. You've got here incoming cash from the senior notes here of around about 1.4 billion, but they've also then repurchased 1.1 billion of stock, and that gives them cash and cash equivalents of just over $500 million. Yeah, looking in terms of what are these convertible senior notes, so we've got debt security that accumulates interest before a maturity date. But the key thing here is the owner of the senior note can convert debt into equity of the company. So essentially, this is potentially a form of dilution of shareholders if the company performed well. I found this Business Wire article from earlier last year around these senior notes. We've seen this cost of around about 1.4 billion, so it ties in with the figures here. And they are going to be unsecured obligations. They're not secured against business assets, which is important. And you can see they're 2026 and 2028 notes, so quite a few years in the future. Now, they use some of the money to repurchase their own shares immediately at a low price. So based on the price of these senior notes, we're looking at figures of $38 and $35 per share. So my reading of this, and it's quite complex, I'd love to hear your comments below. My reading of this is that they've raised a load of money that could be translated into equity at a high value, and they've repurchased shares from that money at a lower value. So I think they're creating value for shareholders in the long run. But the share repurchase that they have been doing could be offset by this to an extent. So it should be noted, by the way, the interest rate on the senior notes is actually 0%. So I've had a look at their results. So part two, I just want to have a look at the trends and the overall assessment. Now, first of all, the company does have a goal to reach $1 billion in free cash flow by 2024. The market cap is currently around about 9 billion. So their free cash of $1 billion compared to market cap of 9 billion. Yeah, that's less than 10 times higher than the free cash flow. That's pretty good. You could be looking at an over 10% a year return. And what we have seen in terms of the earnings per share is that they constantly beat the earnings per share from the analysts. If we look at the most recent 4 examples, quite big beats in 3 of those cases and a smaller in the other case. So if they're saying $1 billion in free cash over 2024, you could probably suggest that might be something like 1.2, 1.3 billion, based on their consistent history of outperforming earnings expectations. And look, the financials trends are definitely improving. The revenue's getting notably larger each year. They've improved in terms of their earnings. There are some analysts that are now picking up on this one. You can see just an increasing number over the months of buys. So Wall Street is starting to find this stock. There's a final really interesting point here, which is the insider ownership. Now, yes, at the end of last year, there was a bit of insider sales, around about $28 million, but look at the individual insider ownership here. We're looking at about $2 billion worth of insider ownership. Almost all of it's with the CEO. I think definitely there's a lot of skin in the game, founder-led company, huge holding in terms of how this can go in the long term. This is a really, really positive thing. So he very much has the incentive to increase the value of the company, either to sell his stake or increase earnings per share so he can participate more in those earnings. So I really like this. So we're going to have a look at the valuation now. So first of all, I'm looking at the estimates on Yahoo for what analysts think is going to happen going forward. They're looking at 16.8% a year earnings growth for the next 5 years. They're expecting for 2022, looking at a high estimate, we'll use the high because they tend to outperform estimates, 1.71, 1.78 next year, but just looking at the 1.71, share price is 23. Now, if you divide that share price by the earnings per share expected for 2022, you're looking at 13. So look at a PE ratio, let's say of around about 13, 14, a growth rate of 16.8% in the earnings. That's a PEG ratio potentially of less than 1. So it looks like it could be attractive on that basis. We also looked at that free cash flow, probably over $1 billion, valuation today of 9 billion. That looks quite attractive. So that would be one way of looking at it. Second way to look at the valuation is to use the Simply Wall Street built-in calculator. Now this, I would say, don't take this as gospel, but it's quite interesting to see this as a checkpoint. Now they've used a discount rate of 6.7% a year. So if you wanted to get a return of 6.7% a year from this stock, a fair price for them would be $60, and they're trading at 23. Now ideally, you're probably looking for more than 6.7% a year, so perhaps you pare that number back a bit. You might be looking at somewhere between 40 and 50 if you want 10 to 15% a year. And again, the current price is 23, so it suggests there is a margin of safety because it's undervalued to get that return of 10 to 15% a year. So the final thing is my discounted cash flow calculator, which you can access through the Patreon or Buy Me a Coffee site. I'm looking to simulate 5 years ahead with Dropbox. I don't think with tech companies you can necessarily more accurately go further than that because things change so quickly. And let's say I want my 15% a year return. So that's a stock doubling, so 100% gain in 5 years. That's 15% compounded. Now I'm going to go with a terminal multiple, essentially a forward PE, a PE at that time in 5 years' time of 15. And the reason I've done that is on Yahoo, the forward PE is shown as 15. So it's quite a low multiple for a tech company, but let's be conservative in the calculation because if it comes out well on a conservative calculation, then we're looking good. Market cap's 9.3 billion and the share price is about $23. There's around about 400 million shares that we'll use as the shares outstanding. Now there's going to be more buybacks, we know, but there's also this potential dilution as well. So let's keep that 400 million number. Now, I've been very conservative here and gone with a 10% a year growth rate. Now, Yahoo is saying 16% a year growth rate in earnings over the next 5 years. I've taken a conservative 10% a year view. Where that leaves us is actually an intrinsic value per share of $31. So to translate that, if the share price, say in the market, was $31, you should expect to get a 15% a year return for the next 5 years. So that's doubling your money. However, the price of the market today is 23. That implies there is a margin of safety between paying $23 and then actually that 31 number, which would give 100% return. So that means one of two things. If the error in my calculation and actually 31's too high, as long as it's still above 23, I'm still right. And I've been quite conservative with my growth rates, what have you. So I think that's good. And the other side of the coin could be, if my calculation is right, the upside actually is more than 100% in 5 years, because it would be 100% at 31. At 23, it would be more than 100%. That this is a stock that can give 100% return and is undervalued for giving 100% return. So here's my holding in Dropbox, just for transparency. I've got 2 tranches, so I've got 45 shares. That average price there looks like it's around about $23, which is bang on the current price. I'm considering adding more to that position based on the analysis I've just gone through. And if you like ShareSite, it gives you news on the stock. It shows you nice positions. So I've got this in 2 accounts. There's a link in the description below where you can get 10% off. But if you really want to boost your portfolio, do not ignore this video here because it's got a great opportunity for you.